Yes, I think we can start now. As of this is a usual slide which I put up, asking people who is this guy. The reason why I'm putting up this slide is to see that whether we are all active. I know most of you know this guy. Why, Shankrama, are you? Shankrama Patil says she is not able to hear me. Um, can you hear me now? Okay. So this man has made all his millions from the stock markets. Why I'm showing you this man's photograph is people think that since there is a lockdown, um, 21 days or another 21 days or whatever, and people have been asking me and telling me that, sir, I'll give you some money. Let's double the money in 21 days or something like that. Stock market is not about doubling money in 21 days. It's about creating wealth over a long time. Okay. Um, let's get back to this example. If you invest 10,000 rupees for 31 years in a financial instrument, how much money would this make? Can you please type in the chat? Can you just type in the chat? Let's see. Yes. I'm not able to see the chat window. Um, anybody? This is that company. If you had subscribed 100 shares, I subscribed in 100 shares of this company with a face value of rupees 100 in 1980. We are in 2020 now. In 1981, this company gave a bonus that made it 200 shares. In 85, another bonus which made it 400 shares. In 86, this company split the share to rupees 10. So now you have 4,000 shares. In 87, there was a bonus. In 89, there was a bonus. In 92, there was a bonus. In 95, there was a bonus. 97, there was a bonus. And in 2019, you end up having 2 crore 56 lakh shares in this company. This company is Azim Premji's Wipro. 10,000 invested in 1980 would have got you 614 crores. That's what is the magic of equities. It is not about making, by investing 1 lakh rupees, making 10,000 rupees every month. That's not what it is all about. It is about making real wealth over a long term. Now, when we do this, Yeah, Ashwin, I think you have got your answer. Wipro has created this 614 crore rupees out of 10,000 rupees investment. Similarly, if you had invested 10,000 rupees in Cipla, it would fetch you 193 crores today. And a 10,000 rupees investment in Infosys in 1992 would have fetched you 78 crore rupees. Why these examples? Because during lockdown, during this phase, there are a lot of companies which are going at a huge discount. There is a big discount sale happening in the stock markets these days. Now let's look at this Sensex from 91 to 2019. Right from somewhere near hundreds in 91, somewhere in the hundreds in 91, you end up having in 2019 nearly touched 40,000. Of course, in 2020 now it has touched 31,000. But 31,000 is also not a very bad uh, rate, bad index. What does this show? This shows that in the long term, there's a lot of money to be made in the stock markets. Another thing that people ask is it the right time to invest in the stock markets? There is never a right time or a wrong time. There is always a right time to buy stocks if you are buying. Yes, Mr. Basareddy. My client, Mr. Nargulkar, retired at the age of 45 because he had Infosys shares bought at close to 150 rupees. See, this is possible. It is not that it is impossible. Only thing is one has to have the patience. Today, if you look at, I will share the I'll share a Bombay Stock Exchange website with you. Just show you what kind of possibilities are there. Legally, I'm not supposed to recommend stocks, but just for your information, you can look at this. This is Hindalco. Hindalco was 30 rupees in 2008. It went up. It was available for only one day in 2008, and then it went to something like 200 rupees in the next uh, 5 years. That itself is, makes a lot of money. Of course, they have given bonuses, dividend, etc. So if we keep on being cynical and say that no, this money is only made by a few people, I think we are wrong, because then what happens is, then that means that we are only looking at very short term ideas. What I'm talking here is long term. Yeah, welcome, Mr. Petkar. Once more. Yeah. Now, everybody would ask a question: how will I know which stock to buy, which company to buy? There are so many companies, and uh, there are so many experts around, and how will I understand which stock to buy, etc. For this, I would like to ask you to look at your own life. If you look at your bedroom, people are putting up. They have removed the cotton beds, the cotton stuffed mattresses, and people are buying foam beds. There are two, three companies in this industry. You will find that they are making huge amount of money by selling these kinds of beds. Sorry. Sachin Patil is not able to hear my voice. Are there others also who are not able to hear my voice? Yeah, people are able to hear. I think Sachin, there is some small glitch in your phone. Please try to um, join with mobile phone audio or something like that in the meeting. Okay. Um, so the bedroom example, people are moving from cotton stuffed mattresses to foam mattresses. If you look at the bathroom, people are moving from buckets to showers. They are installing geysers, showers, etc. I'm not talking about the cities. We are talking about the rural area also, where a lot of people live. 60% of the population lives in rural areas. If you look at your bathroom, you'll find that there are some companies which are dominating this bathroom, like Hindustan Sanitary Ware or V-Guard, etc. These are the companies which are making money. You look into the drawing room, you'll find your TV, your DVD player, or your Xbox or whatever, and you'll find a lot of companies which are selling these consumer durables, these durables, and they are all listed. You get into the kitchen, you'll find a lot of products belonging to Hindustan Lever, ITC, Trent Gamble, Nestle. You know, on your way to office, you find so many cars you can count. There will be one company will have uh, 4 cars out of every 5 cars will belong to one company. You will find that as and when new cars are announced, different brands simply take off. These are companies which whose stocks you should be buying. So everywhere you go to office, you come back home, your surroundings, all these things give you enough ideas about which companies are making money in the markets. Don't go by something like, if somebody says that this stock is good or that stock is good. I would say you go by your own experience. You know, there's a homegrown company called Havels, which is into LED lightings. How much money they have made for their investors? Wipro, of course, also has made a lot of money for their investors. So you see, as and when you look for popular products and look for their companies, that is the crux of finding winners amongst the amongst the companies, amongst the stocks. Government policy. The last 1 week, government policy has changed the fortunes of pharmaceutical companies. The day America asked for HCQ, and they made a deal because of this hydroxyquinone, you find that the pharmaceutical companies have hit jackpots. These jackpots happen because things change in the government, in international trade, etc. So be on the lookout of government policy also. The most common brands, the most common products, the most common vehicles, the most common commodities, the most common brands are the biggest investment opportunities. Warren Buffett is the highest shareholder in Pepsi as well as Coke. So whether you drink Coke or Pepsi, Warren Buffett makes money. That said, if you look at his investments, you'll find that he always invests on brands. He doesn't invest on something which is in the air. Right. Then we come to this slide. There are so many photographs here. Always look for how the promoter is, how the promoter has treated his shareholders. You all know that Narayan Murthy has treated his shareholders promoter sincerity is the first thing that one looks for in investing. If the promoter does not make money for the shareholders, then he will only make money for himself and run away to wherever, Cayman Islands, London, or whatever. Only those promoters who make money for their shareholders will stay for a long time. Therefore, if anybody asks you to buy some shares of some company, first look at whether the promoter is sincere, whether he has professionalism in his approach. There are companies where they are very large companies, where their boards, their board of directors, there are maybe 5 people or 6 people. Out of that 6 people, 3 people would be from their home, and the other 3 would be their followers. If you and the stock would be doing very well sometimes, but For the long term, I think these companies are not professional. They would not be making money for the shareholders. Companies which make money for the shareholders have diversified boards, have very good management practices, highly professional and forward thinking, and of course ethical. Any unethical promoter would, if they are into any unethical practices, then obviously they would not make money for the shareholder. There are companies which own 30, 40 private jets. In India, there are companies which can easily hive off their own private jets into a mid-size airline. You can imagine the amount of money that top management uses, companies' money that the top management uses. All the money of a company is company's money means shareholders' money. If shareholders' money is being used by the promoter, then I think if his lifestyle is going to be managed by shareholders' money or the company's money, then I think there is some mistake in the way the company is run. So the idea of putting up all these photographs was not to point fingers or anything like that, just to give you a glimpse of some good, bad, and ugly promoters in the country. No names. You all know whose names are these are. This is a public platform. So I'm just putting up the pictures so that you can put up your own judgments. What do we look for in the company? Past financial performance. Whether this company has made any money for itself in the last 5 years, last 10 years, whatever. And past shareholder rewards. Whether companies have made money for the shareholders or not. There are companies which have come to the stock market only to take money from the shareholders, and then those stocks have never seen that listing price ever in their lifetime. Huge public relations, huge amount of marketing to sell the shares, and once the shares were sold, the shareholders were left with the shares in their hand. So identifying good companies is based on eagle and vultures. Eagles are those companies which rise above and make money for everybody. Vultures are those companies with those promoters who will close down the company and sell all their stocks, all their assets. So asset sellers are vultures. Many times you see that some promoter wants to buy a company just because there is some good building or some good land bank, etc. They are not looking at running the company. They are only looking at how to monetize their assets. So somebody is buying a company for land banks, or to sell that land and make money. That's what an vulture is. Okay. I was with wealth builder or wealth amasser. A wealth builder promoter, a wealth builder company builds wealth for the shareholders, and wealth amasser only builds wealth for the promoters. In India, we have many examples where companies are sick, but the promoter is healthy, and that kind of governance policy is what we should be away from. The next thing that we look for is global connections. Whether the company has global connections, whether it has good technology, the best in the world, whether it is able to sell across the globe, or whether it is purely a local company which uses some local technology and would not be there in the 4 years or 5 years or something like that. Another thing that we look at is human resources profile. What kind of people work for that company? To give you an idea, there is an old example in the end of 1990s. A superstar got one hotshot MBA to run his company, and the superstar as well as the hotshot MBA both went bankrupt. You know whom I am talking about. So whether you only look at hotshot profiles in the human resources, or whether there are real good seasoned experienced people in the company is another thing. Where do you get this information? This information is available in the annual reports. We will conduct another session where I will talk about how to read an annual report. In any annual report, you will find there is a list of, if you get a detailed annual report of a company, you will find there is a list of people who draw higher salaries. And that list will tell you what kind of people are drawing higher salaries. How many people are drawing salaries above that threshold, one. And secondly, what kind of people are drawing those salaries? Are they experienced? Have they put in a lot of time in the company? Everything is available. Their qualifications are available. Their number of years experience outside the company and in the company are available. How much remuneration they are taking is available. So that gives you an idea whether these people are experienced people who really know the business to run this company. So that's what we look at in company analysis. What do we look for in financials? Everybody talks about P/E ratio. Sure, Pramod, take care. What is this P/E ratio? That is market price of the stock divided by the EPS. Market price of the stock divided by earning per share. Now, how is it useful? If you look at companies like Infosys, TCS, their P/E ratios are around 48, 50. That means market price is 40 times or 50 times the earning per share. The reason being, people expect that these earnings will keep on growing at a rapid rate. What we look for in P/E ratios, what one should look for. You look at P/E ratios of various companies in the same business, let's say IT business, or these fast moving consumer goods, or paints company, etc. You look for a category, and in that category you find out whether everybody has the same P/E ratio. If all the companies have the same P/E ratio, or maybe obviously they will not have the same P/E ratio, but there will be an average P/E ratio, and those companies with less than average P/E ratio seem to be better choices to buy those companies, to buy those stocks. If everything else is all right, if they are making losses, obviously they do not, they will have a lower P/E. A higher P/E is basically tells us that this company is popular with the stock traders. The lower P/E tells us that this company has lower growth prospects. So, since in India, PE ratio is a very popular ratio, and tells us whether the company is popular with the investors or not. We would also be interested in a very important aspect of the company, that is cash EPS. Many times depreciation takes away a lot of EPS, and then you find that the EPS is very low. But cash EPS gives you the right yardstick to find out whether this company is really making money or not making money for the shareholders. If cash EPS is very good, that means this company is really making good money. And maybe if EPS is down, if EPS is low and cash EPS is high, that means that this company is investing for further growth later on. The cash EPS is a better yardstick than the EPS. The third thing that we should look for is market price to book value. Book value being the historical value of the share, and market price being the present the value given to it by the market. This gives you a very good yardstick where if book value is less than the market value, then I think it is very obvious that the stock is undervalued. In these times, during the lockdown, you find there are a lot of companies where the market price is less than book value or very near to book value. And those are the companies which will make real wealth in the next 2 years or 3 years. They will really appreciate in the next 2-3 years once these things stabilize and once we get back to normal business. That is actually the reason why I thought I should schedule this kind of a meeting, because we have a lot of new opportunities coming up, because companies are trading at very close to book value or less than book value. In fact, if you look at some banks, some public sector banks, and some of these banks, they are trading at less than book value. As when it comes to banks book value is everything that is there in the bank. And if market price of the bank's share is less than book value, I think you are sitting on a gold mine. And things are not that bad with the NPS too. So that's one great idea that is taking shape. So we'll go back to what we talked about in fundamental analysis. What we basically look at is we look at our daily life, whichever products we see in our daily life, we will try to find out those companies which are selling most of these products to us, and those are the companies which are popular. Those are the companies which have good brands, which are going to make money by selling those products to us, all of us. We also look at these promoters and try to grade them as good, bad, ugly people. And those people who really make money are there for a long time in this business. Otherwise, they would be running away. And we do a little bit of company analysis, trying to find out whether they are making profits on a consistent basis or not, whether they are giving dividends, bonus, etc., and basically rewarding shareholders on a consistent basis or not, whether they are making money for the shareholders or not. I give you an example. how Wipro has made huge money for investors, how Cipla has made huge money for investors. Whether these companies have some global connections, do they have some good technology which they're buying, and of course the human resource profile. Finally, for fundamental analysis, we look at their financials, their P ratio, the valuation ratio, basically P ratios, cash EPS, and market price to book value. So now, that's where we decide which company to buy. Now, next question is when to buy. When to buy is answered by technical analysis. Lockdown is the time to buy. Why? Because the market prices, because the share prices have gone down drastically. We were trading at Nifty of 14,000 2 months back. Sensex was at 40,000, more than 40,000. And yesterday we closed at 31,000 and 9,000. In fact, Nifty had gone down nearly to 7,800 or something. So there have been great opportunities in the last 15 days where we could buy shares. And I'm not saying that this opportunity will not come back. The opportunity will surely come back because of because of various troubles that we are having with the world. Once you get this opportunity, never look back. Grab such an opportunity. Reliance has traded at 880 rupees. What, 1 week back? Today it's at 1200. That is, if you look at, if you average it out at 900 to 1200 is 33%. 300 rupees up in just 15 days. Such opportunities are coming up. Why? Because stock market runs on two basic emotions: greed and fear. These are times when investors have become scared of the stock market and they are running away. When people run away from the stock markets, they sell whatever they want, whatever they have at throwaway prices. That's why we call it throwaway. To throw away the stocks, and that is the time to buy those stocks. And remember, if everybody starts talking about stock markets, if Pan wala or Rickshaw wala or anybody, the most common denominator of the country, if they start talking about share market, that is the time to sell the shares and get out of the market. Because that is the time when everybody wants to buy. And when everybody wants to buy, you should sell, not when everybody wants to sell. All right, there is a new participant. Sheel G has a question. He says, should we invest and enter via equity, mutual fund or SIP? I will answer this question not on the chat, but openly. See, when you invest in a mutual fund, what you are doing is you are investing in a portfolio which is made by a certain manager, a portfolio manager. So he would have a portfolio where he would have put 5% in Infosys, 2% in Reliance, 3% in some company like this. He will not alter his portfolio based on what you want. So his portfolio keeps growing at a certain space. He will, because in mutual fund industry, if you are churning those shares regularly, that means that your expenses will be high. So people are discouraged from churning their portfolio. So when these more mutual fund investors when they buy shares, they keep them and don't churn them too much. Therefore, you end up getting an average kind of return. So mutual funds usually, if you look at equity mutual funds would generate something like 12 to 15% every year for a long term on an average, not every year. On an average, for if you look at for let's say 5 years time, they would have generated 12 to 15% every year. If you look at equity, then you have complete independence, complete control over your portfolio. So you find, if you find you have bought, let's say Reliance 15 days back at 900 rupees, today it's at 1200. You sell off Reliance, you could buy something else. That uh, flexibility is not there in mutual funds. But if you want to be an equity investor, then you have to be a little bit active. You cannot be passive. Even Warren Buffett, for that matter, is not so passive. He is also active. When it does not mean that he buys a stock and then sits on. He only buys a stock and sits on it only if it is a very very long term investment. Otherwise, if whenever he gets a chance, he sells stock, because one of the cardinal rules is you don't get married to a stock. You sell when you get your required return. And next is SIP. There is one big myth about SIP. SIP, people think that SIP will give a lot of returns. Sorry, SIP gives you better returns than your recurring deposit. Instead of putting money in a recurring deposit in a bank, if you put it in an SIP, it will give you much better returns. And because since it will beat the banking RD, I think that is the reason why you should invest in SIP. And don't stop your SIPs because the market is down. The reason why you do an SIP is to take advantage of these down market times. Otherwise, you will not make what money you wanted to make in the SIP. So that, I think, would answer Shield's question. Okay, so what is the investment horizon? Some people invest for intraday. They think that I can come into the market 9:15, the market starts, up to 3:30, I will keep on trading and I'll make a lot of money. There are other people who think that they'll buy today, sell in a day, or sell tomorrow, or day after tomorrow, or something like that. They are known as swing traders. Then there are short-term traders. They invest for a week up to 1 month. Then there are medium-term traders who invest for 3 months to 9 months, and then there are long-term who invest for more than a year. Each one of them has their own philosophy of investment. But if you look at short-term, intraday, swing, and short-term, they are known as traders. They are not known as investors. So that you have to be very, very clear to know that this is trading, not investing. Investing is only medium-term and long-term. There is a difference between investment and trade. And another thing, if you are so keen on trading, I think if you can spare 1 lakh rupees for investment, you should put 10% of that money in trading. Never put all your money in trading, because trading means taking a lot of risks. We have amongst us my teacher also in the meeting. Welcome, sir. I have muted all the participants because otherwise there would be a lot of crosstalk. But we can always exchange on the chat window. So what I was talking about was, you should not look at investment, you should not look at stock markets as another gambling den or something like that. Nor should you expect huge returns from the stock markets. Huge returns come only if you are invested for a long term, not intraday, not swing, not short term. Because the more shorter the trading horizon, the risk keeps increasing. You either make 2% or lose 10% in a day. So that's how the risk keeps increasing. So remember, investment horizons for investors are always medium term or long term. for traders, if you are keen on trading, then I think put only a little money which you would rather lose. If you think that even if you lose, it's okay. Only that much money should be put in intraday or swing trading, not that money that you would like to keep for a long time. Yeah. So that concludes the presentation. Now I'll